All right, welcome everybody. Thanks so much for joining us today. This is Understanding the Real Estate Market with Don Harris. My name is Sean McKay, and this is an American IRA presentation. So, Don, thanks so much for joining us today.
Appreciate the opportunity and glad to join you all today. Thank you.
Absolutely, yeah. So Don is somebody that I've known for quite a number of years now. Really intelligent realtor as well as real estate investor that's located in the Charlotte, North Carolina area. And so we like to carry on this tradition of bringing on guests that are far more intelligent, far more experienced, and far more successful than I am. And thankfully for us, Don fits the bill in all of those categories. So we're gonna get a lot of value from Don today. He's seen a number of market cycles, and so he understands kind of the historical trends and how we can utilize those to kind of move forward with our real estate investing. So I definitely have my notepad here today, and should be good value. So at American IRA, we are considered the third-party administrator for your self-directed account. We are one of what are called the few fully integrated self-directed IRA providers, meaning that we have the same ownership group for American IRA, which is the administration company, as we do for New Vision Trust Company, which is the custodian. That is the entity that is taking responsibility for the assets as well as the cash on behalf of our clients as the trust company, as the custodian. And so for our clients, that gives a few advantages. The first is that we're able to interact with our colleagues on the New Vision side on a daily basis. And so we're able to get real-time information in terms of what is happening in the regulatory world, real-time information so that we can pass that along to our clients. I think the second big benefit for our clients is that because we have the same ownership group for both American IRA and New Vision Trust, we're able to keep our fees exceptionally low. And so that's obviously mega beneficial for you as clients. Typically in the self-directed space, your annual fee is either based on the value size of your account. So as your account balance grows, so does your annual fee. Or the other model is it's usually about $300 per year per asset. And so that can certainly get very expensive as you're accumulating, whether it's notes in your portfolio, rental properties, whatever the case may be. So the great thing about self-directed accounts is that all retirement accounts can be self-directed. So any type of IRA, whether it's a Roth, a traditional, a SEP, or a simple IRA, can always be self-directed. Now, if you have an employer-sponsored plan, a 401k, a 403b, or a thrift savings plan, many times you'll have to leave that employer in order to have flexibility to be able to have that retirement account with any institution that you choose. So typically it needs to be an old 401k, for example. So as you can see from the screen, there are a number of account types that you can decide to self-direct. So the way the IRS code is written is it actually just simply tells us what we cannot invest in with our IRAs and 401ks. So this is by no means a complete list of what can be acquired, but some of the more typical investments that we see from clients. And certainly Don's done a lot of these investments. And so again, phenomenal resource for us to lean on today from the viewpoint of the analytics as well as real world experience. But from the real estate asset class, as long as you're making essentially an investment in real estate, you're not buying a primary residence or a property that you'll get some personal use from for yourself or perhaps for your family, a condo at the beach, a lake house, etc. As long as you're not making those types of purchases, really any type of pure investment can typically be made with these self-directed accounts. So anything from raw land to any type of improved property, condos, single family, multifamily, commercial, industrial, you name it. There's also the ability for these retirement accounts to be the lender and to be essentially the bank for other real estate entrepreneurs, whether it's in a fix and flip strategy, or maybe it's a buy and hold, and they're looking for some shorter term financing. Maybe you're financing a builder actually building a spec house or something of that nature. So a lot of different applications. We also see a tremendous amount of clients that are involved in syndications or funds. So essentially they're part of an investment group, and that investment group will go on to make the acquisition of a apartment complex, or maybe it's a debt fund where the fund is going to lend money to a number of different real estate entrepreneurs as they're moving in and out of deals. So again, as you can see from the screen, a lot of different ways that these self-directed accounts can be structured. And if nothing else, if you're new to self-direction, the main thing that I want to impress upon you is that the retirement account, not you personally, is the owner of these assets. So whether it's the actual direct ownership of real estate, or it is the debt holder, it is the mortgage holder, it owns the asset, so it receives the financial benefit. So if it's a rental property, if there's rental income coming in, that flows back to the retirement account. If the asset is ever sold, the proceeds from the sale of the asset flow directly back to the retirement account. So as I promised, we're going to get right to it. Again, Don Harris, really appreciating you joining us here today, Don. A wealth of knowledge. Again, somebody who's been involved in real estate on the brokerage side as a realtor, also as an investor. So I'm really looking forward to this here today.
Thanks a lot, Sean, and those of you who are joining today. The information we're presenting, we're going to take a real quick look at what's happening with real estate on a nationwide basis, and then we're going to focus in on the primarily the Charlotte market. But as I look at forums across the United States, it's pretty much what's tracking in Charlotte is tracking in most major cities in the U.S., unless it's one of the populations that's people are fleeing from. So, and just again, I'm presenting this based on I'm an agent with Keller Williams here in Charlotte, Keller Williams South Park. And this is my day job. And then I'm an investor in real estate through our self-directed IRA accounts. My wife and I have 6 accounts, and everything I believe that Sean put on that list, we've probably done some of that type of investing. So, feel free to reach out or ask any questions about either one of those if I can help you with it. I'm going to read a little bit of this information today just so that I get it right. This is the nationwide picture here. And as of January of 23, the U.S. housing market began the year in a state of rebalancing. Many buyers and sellers really are cautious while they want to wait and see where the market is headed. And I'm sure that's why you may be on here today as well. You're just wondering, where is the market headed? Nationally, pending sales were 2.5% month to month, making the first increase since May of last year, while sales of existing homes fell 1.5% as of the last measure, according to the National Association of Realtors. Demand for housing persists, but as you know, higher mortgage interest rates have cut into housing affordability, and total home sales are down almost 18%, 22 compared to 21. So really, home sales are rate driven. That's no news to you on here. And there in January, there was a slight downtick in rates. Rates run inverse to inflation. So if inflation is going up, rates are going down. And this is what happened in our country based on regions. And I put this up here because there are folks outside of the Southeast as well who may be looking and listening to this information.
So I'm surprised, Don, because, just trying to common sense through it, there's been so much publicity in terms of the exodus from especially states like California. And so it's interesting to see that as a region is looks like one of the strongest regions. So that's interesting to me.
It is an interesting snapshot, and 1 month doesn't a trend make, but I think you've got some highly desirable relocation areas in that that's a big swath of land right there. So it could be.
Yeah.
So as sales slow, time on the market is increasing. This particular slide is just showing the main factor from the homes availability on the market is affecting that first slide there. Inventory is short, and it's short significantly. Time on the market is increasing slightly. We'll dig into these slides a little bit more pertinent as we go along. With the average time on the market is 26 days as of the last measure, according to the National Association of Realtors. And the big change in the market right now from last year is seller concessions have made a comeback. They're giving buyers more time and negotiating power when shopping for a home. So the previous market was so hot that it really was buyer abusive. And most realtors that I speak with were hoping for a change in the market to where it balanced out and more an even market to where it's just as fair to the buyer as it is to the seller. My notes here, although home prices remain high, mortgage rate declined steadily throughout January. However, I mean, that's relative speaking, because we went from the threes, mid threes last year to 7% at the end of the year. And then at the end of January, they took a little bit of dip as well. They've gone back up this last week. And this spring and this summer, it's projected that rates are going to come back down again. And that could be just great, just in time for the spring selling market. Again, inventory being down, availability of homes, even though it's more than January of 22, it's less than 2 years ago. And really 2 years ago is the closest thing that we have to what's normal. These highs and lows follow the typical calendar of the market, whereas in January, you're going to have the dip just due to seasonality.
Makes sense.
Next.
So Don, as you get kind of granular as you're working with clients in your capacity, as you said, in your day job as a realtor, are you finding that the ebbs and flows of the mortgage rates are affecting their psyche in terms of if we get a pop in interest rates, do you find they're a little more anxious and feeling as though they need to price their properties differently? Like, can you speak to that on kind of a granular level there?
Yeah, that you hit it right on the head. And this slide, I wish it were still true, but because we are a day by day and a week by week and a month by month market that changes, rates dipped to 5.99, and the mortgage providers that we work with saw a huge increase in mortgage applications just based on that news. I was listening to the mortgage economist Barry Habib, and he made a comment that a 1% rise in mortgage rates takes 1 million potential buyers out of the market. But a 1% decrease in mortgage rates adds 5 million buyers to the market.
Wow.
So that's why this spring market and limited inventory is really going to put us back into the way that the market was. Well, right now we're in the mid 6% range for your personal home investment. And as investors, which I'm assuming most of you all are on the Zoom call today, the rates are significantly higher than that. And I've seen no news of the second home or investment home rates coming down significantly, primarily only on the primary home. So as rates drastically affect the expectation of the buyer market and puts people in the market and out of the market just based on quarter points, eighth of a points changes. And I do believe that if the rates get back down into the sixes and dip into the fives late spring, then we're the folks who missed out on the 3% and 4% rate are going to be very intent on not missing out on that opportunity.
So it's almost, do you feel as though, Don, it's almost like we're getting accustomed to kind of a more typical historical reality that, you know, the 2-3% was such an extreme anomaly, and what we should expect in pretty much every other moment in history is going to be, you know, 5, 6, 7, 8 type of range?
Exactly. Historically, I think rates have averaged in the 6% range. And with COVID and quantitative easing, the rate was artificially kept low. You know, we had stimulus checks to businesses, to individuals, and rates were kept low. And so the market was artificially stimulated for too long of a period of time. Our government said that inflation was going to be transitory, and it looks like it's going to be with us for a while. So we're just responding to a lot of factors.
Yeah, makes sense.
Okay, so Canopy is the MLS for the local Charlotte area, and this is a regional data that we're going to go through here just to see what different items are affecting the market. The average list price has gone from over the last 3 years, 371, 425 to 454. So coming out of the gate in January of 23, 454,000 is our average list price. And so the price, this is what you as a seller you're very interested in. If you're flipping a home or building a home, or you're lending to someone who's doing that, then how is this recession and economy affecting price? And even though inventory is rising slowly, the price continues to increase on an ever increasing basis. The rate of increase is what has changed. Okay, so that's your average price. The next slide, list price. Next slide will show average sales price, which correlates right to average list there. So 3 years trend again, 339, 392, 417. The rate of increase of the average sale price has the rate of increase has increased, but prices are still increasing. So I get this question a lot from people. Shouldn't I just wait till the market crashes in order to get back into the market? I've got bad news for you if that's your anticipation. The market is not going to crash. We have too many forces driving demand and limited supply, so that it's still a pure supply and demand situation. There's so much pressure on the real estate market that despite higher than recent interest rates, but historically normal interest rates, folks have the misconception that the market is going to greatly correct. Now, there are a few places in the country that people are fleeing from in order for better economies, politics, weather, whatever, that are going to have sharper price decreases. They also had sharper price increases at the same time. in the Charlotte area, our price decreases. If you see price decreases in the MLS, then it's merely a reaction to slightly overpricing the home from the get-go. Sellers still are thinking that we're in this real hot seller market, and we are in a very warm seller market, but it's not the crazy seller abusive market that we were in last 2 years. And so when they put their home on the market, they remember what the neighbor said, next door about just the abundance of showings, the abundance of offers, the unlimited bouquet that all buyers are offering them with their offers, price and due diligence and earnest money and no inspections. And you can stay in the house after we buy it, and on and on and on. So those right now are, I wouldn't say over or done with, but they have moderated back to the buyer's advantage. And it's made it a much more fair market. So real estate agents look at days on market for counting the health of a market. And this is showing a whopping 100% increase in year-over-year days on market. But it's still just 46 days on market between contract and close. And so it just shows us that a house is staying on the market a few more days, but a well-priced house in today's market is still going to go under contract, most likely in 7 to 14 days. I said a well-priced house. If it's still fishing, reaching for the stars, then that's not going to happen. A balanced inventory on the market is 6 months of inventory, to where if you sold every house that was available, it would take 6 months to consume that much inventory. And so we're far from that at this point in time.
So Don, could you speak a little bit to the idea of well priced? Because we certainly have a lot of clients that are transactional, they're wholesaling, they're flipping, they're doing different activities. So if you're in a retail neighborhood where, let's say, the average price for a similar property over the last 6 months has sold for $500K. Are you advising clients we're right on the button for that 500? Are you still able to push a little bit? Are you coming off the 500? What just, broad strokes, what do you look at there?
Yeah, that's a great question, Sean. Well, last year, that house that sold for 500 may have been listed for 450. And so it was not uncommon to get 25 or 50,000 over list price. And so now the benchmark is at 500, not 550. And so that's where the correlation breaks down. The tide does lift all boats. And so appraisers use homes that have closed in the last 6 months, and they start with homes in the same neighborhood if possible. If it's a 2-story, it's the other 2-story homes that have closed. If they do not find comparable homes in the neighborhood, then they just go out in a radius from that particular house. And so the tide watermark has now been set at 500. And so when buyers are looking to buy and their budget is in the 500 range, then MLS searches are set up in $25,000 increments. You would be better to price that house right at 500 in order to attract all the eyeballs who may be interested and qualified to buy a house at that particular price range at this point in time. Because you need to get the eyeballs on the house via the internet in order to get the showing appointments in order to get the interest, in order to still potentially get competitive bidding on the house. And so my advice is to price the house to the current market, create competition, but let the market raise the price if it wants to. The last 4 houses I've shown in the last week to different clients have all sold either sight unseen, multiple offers, or within 2 or 3 days. 4 houses in the last week.
Mhm.
Just a month ago, that situation did not exist in the market. But it's both buyer optimism, expectations that when rates do decrease, then I'm going to be competing with so many more people. And so are you better off now to get the house that you want to buy that fits perfectly for your family and not be competing against 25 other offers and potentially pay a little bit over, maybe not, maybe pay a little bit less than list price, knowing that it should appraise for the number that you've offered and has been accepted, not having to pay exorbitant due diligence fees. If you're outside of North Carolina, you may not understand what due diligence fees are, but in North Carolina, in addition to your earnest money, it's a fee that the buyer pays to the seller upon acceptance of the contract to buy a period of time for due diligence and for you to do your inspections and have the appraisal. But that fee is non-refundable. And so also in addition to the wacky prices in the last 2 years, the due diligence fees were ridiculously high, and it puts too much risk on the buyer. So long answer to your short question there, Sean. Did I get close to it?
That was fantastic. Absolutely.
Incentive list received. So this kind of proves the point that I was just making, where last year nothing sold on average for less than list, and 1 month in to 23, then that percent of close price is right at 95%. So a 5% discount to list price was January's. I believe that rate of margin is going to tighten up again as the year goes on. Next slide. So this goes back to where we started, how housing affordability. And you may have heard this. You probably can't read the little text at the top of the page, but it says the Housing Affordability Index measures housing affordability for a region. For example, an index of 120 means the median household income is 120% of what is necessary to qualify for the median priced home under prevailing interest rates. A higher number means greater affordability. So this is a picture of what has really happened in our market the last 2 years, and then how we ended the year and began 23. The last 2 years, even though prices were going through the roof, it was offset by unrealistic, unhistoric interest rates, artificially low, which offset the price. And so people did not mind paying up to get the house that they wanted because it was still affordable according to their income and their budget. So now the high water mark is to this house Sean mentioned, 500,000, just as an example. but rates have gone up. And so now the affordability of that particular house is dropped to nearly almost 20 points. It is 20 points in there. So that takes a little bit of steam out of the market, and therefore houses will be on the market a little bit longer. Buyers are being more choosy right now. They can afford to be a little bit more particular. What this affordability index, however, does not include, and therefore what I believe is somewhat artificially low, is it doesn't include the wages increases that employees were able to obtain in 2022, which were in the 9% range, and are also forecast to be in the 9% range of wage increases, because inflation puts pressure on wages as well. So if you're one of the fortunate to not lose your job during high inflation, then your income will be increasing. And that wage increase is not factored into this affordability index. So all that being said, if we get to late spring, early summer, and we see rates in the 5% again, even though prices are higher, when you factor in rate increases, we're going to be in the high 90s in terms of affordability index. We even could be over 100%. Theoretically, it could even be less expensive in 23 under those circumstances than it was in 22. And I know you think I'm wacky when I say that, but that's just how the numbers work out.
Don, sorry, I might have missed this. Have you spoken about what is kind of an equilibrium for an affordability index number?
Well, equilibrium is 100%. So
100% is kind of ideal then. Okay.
So the last 2 years have been 99%, and the index on particular months, when you look at it on a granular basis, you will see that it does jump up to 110, 120% at some points in time and history. 100 is ideal.
Okay, great.
So the inventory of houses is at a very low point, even though it's increased from year over year, and that number as a percentage seems like a high number. The actual numbers of houses for sale is a small number. And the things that affect the inventory of housing for sale, it's a long story in terms of the economics, but family creation, families being created are ever increasing, and new home creation by builders has been on a decline. And so we've got an imbalance that would take multiple years to correct, assuming that builders were going at full speed and interest rates had moderated. And so we are going to have a shortage of inventory for a long number of years, which is where the number of homes on the previous slide translates to month supply of homes. This is how realtors talk. And again, a 6-month supply of homes is a balanced market. And so even though we had a 100% increase, we're only talking about 0.7 of a month to 1.5 months inventory available. And like I said previously, the builders control inventory, new inventory entering the market. They manufacture homes. Certain number of homes get demolished every year, and a certain number of families get created and new family units enter into this housing market. And there is such an imbalance between house creation and new family units to where we're going to have an imbalance for demand for houses for many, many, many years to come. And there's no magic solution to that. And this was exacerbated by the low interest rates, which took a lot of houses out of the market. And we also know that a lot of national funds entered the national rental market and absorbed a lot of those houses paying cash, thus competing with the home buyer. So it's a complicated problem for housing. There is a shortage of housing. And so you can rest assured that buying a house is still a great investment. It represents the majority of the wealth of most families. So buying power's on the decline due to interest rates. Mortgage rates are going to remain elevated, but should decrease come spring and late spring. Home prices are growing, but slowing. Going back to the math of the Sean's typical or desired neighbor's house of 500,000. Let's say you bought that house and you're wondering, is it still a good investment? Is it still a good time to buy a house, given all the places that you can put your money in? That house is 500,000 now. You have 100,000 to put down. Well, we've seen 20 and 30% increases in prices in the last few years, and we're not going to see that. But historically, over the entire life of real estate, the price of real estate has risen 3.5% a year. And it's projected in 23 by economists and the National Association of Realtors that the rate of increase will moderate 5.5%. So as an investment, if you buy this $500,000 house and you put $100,000 down, $100,000 in down payment, and it rose by 5% at the end of the year, then what is your rate of return? The rate of return is based on 5% of the value of the house. So that would be $25,000 increase in value of the house. But you only invested $100,000. And so your return on your cash investment is $25,000 on a $100,000 investment. And without understanding or doing the math over a long period of time, this is how a lot of families have just become more secure and more wealthy by buying their personal residence, even though rates are high and prices are high. Does that make sense?
Absolutely. Yeah.
Okay. And, the last thing is, I don't get into this too much, but a lot of folks think, well, I'll just keep paying rent until until the market crashes or until rates decrease and whatever. And you miss out on that even 5% increase year over year in the foreseeable years for protecting your housing dollars. Once you buy, your rate is fixed. And if you continue to rent, then you're going to continue to be subject to rate increases of the landlord. A friend of mine says that you're always paying a mortgage payment. You're either paying your own or you're paying for your landlord's. And doesn't it make a whole lot more sense to pay for yours versus your landlord's? So that's pretty much the last slide there, Sean. If you've got any questions or if anyone's put anything in the comments that we can follow up on, I'd be glad to do that.
Yeah, that was fantastic, Don. I appreciate it. And so one of the things that's come up a few times, even just since we put out the blast about this, this conversation was any information or insights or thoughts you have on the institutional buyers. Certainly a lot of metros such as Charlotte and a number of others have seen a tremendous amount of activity over the last, call it 10 plus years from
Yeah.
those big institutional buyers. Is that still in play? Are they selling? Are they holding? What are you seeing or hearing there?
Uh, Well, they don't show all the cards because most of them are public companies, and it's a long-term investment strategy for them. I've not heard of any who are peeling off any inventory. Once they have the taste for single-family residences as an investment, then their taste buds liked what they saw and they continue to devour properties. The disadvantage that you and I have is, they can pay cash and they can close quickly and move on and on, and competing with the individual who has to have a mortgage and has to have an appraisal in order to close their loan. I don't see their appetite diminishing. Just about every listing that I had the last 2 years would have multiple offers from investors competing with the home buyer trying to acquire that home. I've had sellers who say, I don't care what the price is, I do not want to sell to an investor. And I've had sellers say, may the best man win in terms of price. And now, because housing has gotten more scarce, and yet as an investment, it's proven to be a great asset category. So we've seen these large investment groups go in and start building subdivisions and both single family and townhouse subdivisions for rental from the get-go. So it's build to rent. And you think, well, yeah, that makes sense because they're going to hold it for a long time and it's single family. So it's going to appreciate like single family, and yet it's rental property, and I'm going to get market rent, and I'm going to get a great return, and I'm going to get the tax advantages of owning investment real estate. But boy, I can't compete on their level. And I would disagree with you. There are investors here in the Charlotte market who are buy and hold rental investors who have changed their strategy from buying the house and competing with the other home buyers to buying lots and building houses for rent. And you may not be able to do a whole subdivision, but you can acquire lots and build one at a time and acquire your own build to rent portfolio and compete right along with them on your own scale.
Yeah, that makes sense. So, Don, we did have a direct message here. How is purchasing land in Texas different from purchasing rental/income properties?
Specifically in Texas, you said, or Texas?
Texas, the state of Texas.
I can't answer that one. But because real estate is local. I'd say from a theory standpoint, it all would be the same. I don't know if there's any local Texas burdens or opportunities that may give an advantage or disadvantage on there. But buying land either to build on, to subdivide, to flip is always a great strategy. If you can buy a parcel of land, probably the people who make some of the best money are those that can see a parcel of land and draw little lines on it. I'm oversimplifying here, and divide it. And the sum of the parts is worth a whole lot more than the whole was when they began. And again, you may not be able to take down 5, 10, 50, 100 acres. But I've seen plenty of investors. I've used my self-directed IRA to fund investors in the local market who bought a single-family residence and knocked it down and converted that particular location to either 2 or 3 lots, and then built 2 or 3 homes on that property. And whether it's rental property or land, figure out all of the particulars that go along with that opportunity and learn all of those before moving to the next one. Land has its unique opportunities, and that's also very local, state and county and city and municipality regulated. So what you can do with one particular piece of property in Matthews, North Carolina may not be what you can do in Gastonia, North Carolina. So it's very specific. And with a house, it's not that restrictive. Pretty much any house, unless it's short-term rental, can be converted to a rental house. Not necessarily the same with a condo or a townhouse. If you're buying those, you want to make sure that there are no restrictions on renting those properties prior to going to closing. And there are even a few subdivisions that have tried to put restrictions on rental houses in the Charlotte area. And I'm not certain of any success with that, but just make sure that there are no restrictions to rent when you make the acquisition.
Yeah, that's a great point. And so kind of along with the institutional buyer concept, Don, it feels like the what they would call the iBuyers, the OfferPads of the world, the Zillows when they were buying houses. It seems like that's, if it hasn't completely stopped, it's certainly they're not cranking at the volumes that they were over the last few years. Is that what the data is also showing, or do you have any thoughts on that?
Yeah, well, a few have quit buying. It turned out to be not the model. The flip model for the institutional buyer has not proven to be scalable, I guess is the right word. And if you're on this podcast and you flip houses, you know how difficult it is to, number one, acquire the property. Number two, to find the trades to do the work in a cost-effective and timely manner in order to turn that property and to still make a profit. So trying to do that on a grand scale, I think, has been very difficult for the iBuyer, and therefore several have exited the market. And I don't think any of them will miss them. The ones who are still acquiring for the purpose of long-term rental are still in the market. Not as aggressive, however, and that just may be a factor of limited inventory or shifting the model to building for rent as well.
Yeah, that makes sense. All right, so one last question here. So Don, what areas are you seeing the most active in people leaving the area and fleeing to other states? So do you have kind of a macro national perspective there?
Yeah, it's the proverbial bad news that if you happen to watch a little bit of national news, it's the New Yorks, it's the Chicagos, it's the Californias, and they're just fleeing to, I think COVID was the first impetus to that. People realizing that if I can work from home and my job is via the computer, then I can live anywhere. And so that was the greatest stimulus to this redistribution of exodus of people from restrictive areas that were more restrictive to the COVID regulation. And then the interest rates being what they were, put a whole lot more money into the economy and just open the floodgates for that. And I don't think that trend is going to end anytime soon. Our workforce is rebalancing as to where you can live and where you can work. And if you still must work, then you may as well work in a climate or a town or near people or a family or whatever that adds to quality of life. And so if there's one good that's come out of COVID, it's probably that. Then it gives us the option for a lot of us to live where we want to live.
Yeah, that makes sense. I've had a number of conversations with partners at very large financial services firms, and I was initially surprised. Now it's become kind of typical to hear that they've talked about that, as you said, remote work model in many cases as a permanent strategy. And I think in a lot of cases, it's going to end up being cost effective for the firms in the long run, not having to worry so much about office space and not nearly as much equipment and things of that nature. So yeah, that makes sense.
Yeah, Charlotte's probably not going to have a collapse of office space anytime soon because our jobs market is too good here. But I don't know that I'd want to be a commercial office space landlord in New York City, for instance, where the vacancy rate is 3, 4, 5 times high as what it is in the Charlotte.
Yeah, absolutely. Well, Don, this was amazing. I really appreciate you doing a deep dive into the stats. And, as you said, there's a lot of points of news that we get in the media, and usually not even financial media. And so it's very difficult to understand where we are in the different market cycles and national as well as local to those that are in the Charlotte area.
Yeah, the main one is that the sky is not falling in price, and we're not going to have a collapse in real estate. And I'm optimistic that rates are going to come down this spring and late spring to where it's going to more normalize. So, this is my day job, and investing and using my self-directed IRAs with American IRA is my night job in my investment strategy. So it's worked out well thus far.
That's fantastic. And Don, if you don't mind, we'll be happy to send with the recording your contact information if you're open to that for those in the Charlotte.
Anyone on here, feel free to reach out to me. If I don't know the answer, I'll find the answer or find someone who has the answer for you. And if you want these slides, then also just send me a request and I'll get the slides. I can send you the whole unabbreviated deck if you're a detail geek for data and real estate information. And I just want to give a plug to American IRA. I was with Brand X for a long time, and my wife and I have 6 accounts with American IRA, and we made the change because the fees were so much more agreeable with American IRA, and the service has been every bit as good as well. So I'll give you a plug as well. And if anyone has any questions about using your self-directed IRA in terms of real estate from a person who's using them, my wife and I have done hundreds of transactions. And if you're new to that and are exploring that, then I'll be glad. I wouldn't be able to direct you like Sean can, but I can tell you real world experience from my own, what we've done personally.
That's fantastic. I really appreciate that, Don. And so again, appreciate everyone who's joining us live and those that will listen to this on the recording. Thanks for your time. And thank you for those listening live with your questions and feedback. And again, Don, thank you so much. Don Harris, local realtor, Keller Williams South Park in the Charlotte area, phenomenal resource for those of you that are local, looking to network, looking for realtor resources, really, really sharp individual. And Don, thank you so much for your time today.
My pleasure.
Thanks, everyone. Have a great day.